Time now to get a check on the fixed income markets, and we've got Suyash Chaudhary, who's head of fixed income at IDFC. He joins us on the show from Mumbai. Suyash, to begin with, we've seen a fair amount of optimism climb back into the fixed income markets. We've seen yields in the 10-year benchmark climb down to levels of 8.32%. Is the market somewhere developing, or rather building up some level of certainty that we will see a rate cut on the 18th?
Yes, it is definitely beginning to price that in. If you remember, when RBI cut rates by 50 basis in April, they guided limited room henceforth, and that was basically against an assumption that growth had bottomed in the December quarter and that it's subsequently rebounding. Now the 5.3% GDP growth for March quarter clearly challenges that assumption. Add to that the global volatility and a sharp correction in commodity prices that we have seen. So market is definitely building a decent chance for a rate cut on 18th June.
Right, but Suyash, on Friday afternoon, you had one of the deputy governors come out and say that, don't expect a rate cut because inflation is high. Just a few hours later in the evening, the same evening, you've got another deputy governor who says that, yes, I think we ought to cut rates now because growth is taking a hit. Aren't these conflicting signals somewhere confusing the markets?
Yes, I mean, in the sense of more room, it cannot be disputed that RBI now has more room. But like you say, whether they actually go ahead with a rate cut or not is a question mark still, no matter what the bond market is pricing. If you ask me, the first thing that really needs to be done is to tackle liquidity more aggressively, because what we saw with the April rate cut as well is that transmission of that rate cut was very limited because liquidity deficit rose all the way back to 1 lakh crore. So our view would be that from a perspective of bringing down lending rates in the economy, they have to first tackle liquidity deficit more aggressively, which would then ensure that lower rates are transmitted to deposit and lending rates.
So clearly tackling liquidity seems to be the topmost priority. So how do you view the OMO action that has been taken in light to address the liquidity deficit in the system?
Yes, RBI has proven very aggressive with OMO so far. So between April and May, they have already done close to 55,000 crores on OMOs. We do expect between October and March, which is busy season on credit, and we see a leakage of in excess of 1 lakh crore on currency with public. We believe during that phase, RBI will again step in with quantum OMOs. So our assessment would be, between October and March, they will end up doing OMOs in excess of 1 lakh crore. In the meanwhile, for this quarter, remains to be seen whether they do some minor adjustments to CRR. What market is watching out for is, will they finally get very serious about defending their 1% NDTL target on liquidity, which stands approximately at 60,000 crores.
Right. So, and given the kind of GDP numbers that we spoke of, and that George mentioned the conflicting signals which have been coming out from the RBI deputy governors, how do you expect the bond yields to trend, and would you be cautiously pessimistic?
From here till 18th, there is some bit of a momentum to bond yield. So sections of the market even expect the announcement of a new 10-year for the auction scheduled this week. Should that happen, that would give some fresh impetus to the bond rally. But, I would agree with you that post the 18th or going into the 18th, I would view this with caution, because if you look at the last 2 months, RBI has done OMOs of closer to 55,000 crores. We had bond maturities of around 58,000 crores. So these two combined have ensured that net supply of bonds to the market for the last 2 months has been virtually zero. If you look at the next 2 to 3 months, the supply to the market will be in excess of 1,50,000 crores, because we are not looking at any major bond maturities now, and only the pace of OMOs will decide how much supply RBI absorbs. So, wherever we are on 18th of June, I would look for bond yields to head a little more higher for the next 2 to 3 months after 18 June. The question only is between now and 18 June, what kind of a rally you see.
Sure. So, Suyash, on when we do get the monthly inflation numbers, and if that number looks lower than the previous month, would that add to a, again, fuel the current rally that we've seen? And would you say that that would be the final clincher in terms of expectations in the fixed income markets of a rate cut on the 18th?
Yes, it would to a very large extent, that and the announcement of a new 10-year. But, like we said, this phase of the market has to be approached more from a profit booking perspective, with a view that the supply pressures after 18 June should possibly give you a little better opportunity to build fresh longs in the market.